Good afternoon, everybody. Thank you very much for joining us. Really appreciate you taking the time. I'm Peter Vines from Ray White Commercial. Today we're going to be talking about all things commercial real estate in Western Sydney and also finance. I'm joined here today by our good friends at Stamford Capital. Harley.
How you going, Pete?
Fantastic, thank you.
Sway. For those of you who don't know, Stamford Capital, in essence, we're we're a debt advisory business covering development and investment finance, and I guess similar to Pete and Ray White, we operate solely within the commercial property space, covering asset classes such as retail, industrial, childcare, residential development, and office. So that's a bit of us, Pete.
Thank you. Look, one of the reasons we decided to work with Stamford was we have very big aspirations for our business to be, number one across Western Sydney. And so in order to do that, we need to partner with the best people. And we truly believe that is Stamford, particularly in the commercial space. They're dealing with commercially minded people all the time. And so that was why we started working together. Okay, so what are we going to be talking about today? Firstly, I'll cover off on, I guess, some of the trends and things that we're currently seeing in this unusual market. Secondly, Harley will cover off on some of the things that he's seeing from a funding perspective, from an investor perspective, but also the development perspective. And lastly, we will be open to questions. So we have already received some questions. If there's anything that comes up for you during the presentation, there's a question and answer poll where you can just tap in your question, and we'll do our best to get to those at the end. If you don't want to raise your question in this format, you're more than welcome, obviously, to make contact with either myself or Harley afterwards. So let's get going. Okay, so what are we seeing at the moment? Obviously, there was a significant rise in interest rates, and there sort of has been a lot of speculation about when and will they come off, and if and when. And I think what that really is doing across the market is causing people just to be a little bit cautious. I think in a bull market, people will be far more aggressive in terms of, what they're buying, but they're just being that little bit more cautious at the moment. Land is still very challenging. I think there's a number of builder developers and just developers in general who have really kind of struggled with the increase in construction costs, but also where funding is at. But also leading back into consumer market sentiment. It's harder to sell things off the plan. Councils are still very difficult to get planning through. So it really just remains a lot more challenging than the other asset classes. Investor uncertainty. I think that probably is one of the bigger things that we're seeing at the moment, is just investors sitting on their hands somewhat. The sorts of people who we're seeing in the market are far more seasoned investors. They're more sophisticated. I think they are they're getting into the market now because they believe that now is the right time to buy. Because as soon as interest rates start coming off, there probably is likely to be, I guess, a greater influx of buyers into the market. Back to real estate fundamentals. This couldn't be more true than, whenever there's a more challenging market, I think people are just that much more cautious. You need to be, you're buying tenants, you're buying location, you're buying future income, you're buying development potential. And so this is really, I think, when people have less time to reflect because it's such a bullish market, people will be more aggressive. They'll sort problems out later, but now more than ever, people are just being more cautious and going back to those fundamentals. Industrial land. It comes back to land, as I talked about previously. It's more challenging. Rents have started to sort of, I guess, just ease. They haven't started to come off, but certainly I think that demand from the industrial users has started to slightly soften. There is still good demand from the owner-occupier market, predominantly in freehold. The strata market remains more difficult, and we are still seeing that there is some caution from that market. Residential developers. So look, I think residential, we all know that there is a housing crisis. There's been a huge amount of immigration into the market. There's an undersupply of housing. The challenge is that delivering housing at the moment is just very difficult given where construction costs are. And so we can see that there's this pent-up demand which is just building. We can see that from the end purchaser, some of them don't want to rent anymore. A lot of them want to get into the buying market, but serviceability is really challenging. And so what we're seeing is that residential developers, they do want to buy, but they don't want to be delivering now. They want to be delivering in 18 months, 24 months time down the track when they believe that things probably will have normalized and that demand will have really kind of come back into the market. So strong opportunity to buy. It's always the best time to buy. No, I have said this to a number of people in the last few days. Buyer numbers have certainly thinned out toward the end of the year. I think this is for two reasons. One is because people believe that best buying will probably be next year. But my whole thing is buy when others are not buying. There's always a reason for people to sell, particularly at the moment with, pressure potentially being on some of these vendors who are sitting on land or investments that they just are unable to hold, or they feel like they will be unable to deliver. And so coming towards Christmas, there is always more stock that comes on, and I think there could be very good buying opportunities. Again, there is very good buying opportunities whenever there is fewer people in the market. And so I would strongly suggest that, if you are looking at buying, you keep an eye out because there could be value which presents itself this year. So next year, what do we see? Look, I think it will be probably quite similar to this year. I think that it will kind of just sort of bubble along. I think that despite the talk of interest rates coming off, I do think that will probably bring more people back into the market, but I don't think it will give us this kind of ferocious kick in values. I think that my feeling is that, just with where things have gotten to, the economy is just still sorting itself out, and probably has maybe a little way to go. But I think that, next year again will present some of the challenges that we've seen this year. I don't think that they will be resolved overnight, but I still think that, fundamentally we are in a very good space, and that, again, in any market there is very good buying. So I'd be really kind of encouraging people to get back in and start looking, get terms if you can on things. So that sort of brings me to the end of my very brief commercial update. I've kind of gone all around the world in 3 minutes. But again, if you have further questions, please feel free to reach out. So
perfect.
Harley?
Thanks, Pete. That was really insightful.
Now the interesting part. Show me the money.
As Pete touched on, I'll be covering, I guess, 3 different topic areas, discussing what we're seeing from an investment perspective, development and owner-occupier perspective. Just quickly, and firstly, we'll touch on investment funding. And first, what do we mean by investment debt? An investment facility is a facility whereby interest is serviced, and we typically set one of these when a client of ours is out in market looking to purchase a built form or established asset that is income producing, has a lease in place. That's when we'd set an investment facility. In terms of what we're seeing from the banks and your non-banks, the banks have remained very competitive within this space, and appetite does remain very strong for investment transactions. Still very cautious, as they always will be. However, when such as number 1, strong serviceability, a long WALE, and I guess a good tenant covenant, I find that the banks are swinging very hard and pricing very competitively in order to win these transactions. Then you've got your non-banks on the other hand. So when something sits outside bank territory, they still provide an interesting offering. However, most of our investment transactions are being pitched with the banks, given that they are cash flow plays, they're longer term holds, they're a bit more rate sensitive as opposed to a land bank or a construction facility. I guess the main benefits of going down that non-bank path, I guess they're just a bit more flexible all around. You're paying for it in terms of you're paying for the premium.
Yes.
But they're more flexible with reference to their servicing covenants, and I guess they can gear up a lot higher compared to your banks as well, right? So I think that's where the non-banks have their, I guess, space in the market. In terms of your popular asset classes, look, industrial's the obvious one, just given, I guess, the rental growth and I guess the low vacancy over the past few years. I don't think that's anything new there. In terms of asset classes that I guess have had their challenges over the past few years, I think office is that obvious one, off the back of rising vacancy rates, softening yields, and I guess an increase in incentives as well. It has been challenging to, I guess, get those office transactions done with the banks and the non-banks. However, we are starting to see that script change. I'm working on a few suburban office transactions at the moment. Buildings aren't fully let. They present okay. And I guess the banks are still keen to look at these again, which is, I guess, pretty exciting. It just shows the appetite from the banks.
Great time to buy office is what you're saying, isn't it? But like
it's still got its challenges, but
obviously,
I think just given the amount of competition from the banks at the moment, that sort of leads on to my first common trend that I guess we're seeing in the market. It is that, I guess, increased competition. We have seen, I guess, we call it a surge in lending appetite amongst the banks, right? And that's put pressure on, I think, banks in particular in the investment space to, I guess, reduce their interest margins. Pretty interesting. What was a good interest margin, call it 24 months ago, is certainly not anymore. Where margins were, say, 2% over the base rate, they got to a point whereby they were over 1% over the base rate, and now they're as low as 1.5% over the base rate, right? And that's just off the back of that increased competition from the banks in the market, right? And I think our role as a broker, and I guess our value add plays right into that, our ability to, I guess, create that competitive tension and I guess elevate that competitive tension. We find that that's the best and the most transparent way to, I guess, ensure our clients that they are receiving, I guess, the best funding solution in market, right?
It really is funny though how it ties into like the trends that we're seeing in the market as well, in terms of like the fundamentals around, and that's a real estate 101 thing, but good property is good property. And the banks are like, everybody wants to get in and support that. So it's much easier to sell. But as soon as there's kind of those unknowns or uncertainties or things about the lease that are a bit quirky and that type of thing, it just, it's not that core kind of value. And so it falls into that other bucket of, lender.
100%. 100%, Pete. Just next, I guess the next common trend that I guess we're noticing is just around servicing covenants. And I guess to give you guys a bit of context around that, during, I guess, 2023, we noticed that there are a lot of interest cover breaches. And I guess what I mean by interest cover, it effectively demonstrates how well the property's income can service the debt. We saw that off the back of rising base rates that there were a lot of breaches. However, quite interestingly, we didn't see a lot of lenders act on those breaches, and they've been, I guess, a lot more flexible moving forward, which is a good sign for borrowers. Where your interest cover covenant was, call it 1.5 to 2 times, we've definitely seen that pull back with all the banks. Some banks are as low as 1.2 times, and testing without buffers on top of their actual rates as well, just given, I guess, where the general sentiment around the cash rate is going. So I guess that's good for, I guess, an investor's serviceability. And lastly here, just my last point around attractive incentives. What I mean by this is that given, I guess, the amount of competition that we're seeing in market, lenders are doing, I guess, anything they can in order to, I guess, win business and win transactions, whether that's waiving legal fees, waiving valuation fees, or reducing establishment fees. Just given, I guess, that amount of competition, lenders are trying very hard, especially in the event of a refinance, and to win business off a competitor. Right? Banks are very competitive, and they'll go very hard. They'll swing very hard. So, yeah, all things happening in the investment space. In terms of your construction funding, firstly, I just wanted to touch on what we're seeing in the private credit market. We've found that, I guess, it's become a very popular funding option for developers, just given, I guess, the benefits that they can provide. I think
huge flexibility.
I guess the products that they provide like directly align with what developers need and have been, I guess, calling out for many years, right?
Yes.
Some of the benefits, and I know this is probably not new to everyone on the webinar, but no pre-sale products, key for developers, high leverage,
particularly based on what we've seen.
Totally, yeah. And just flexible, like you said, right? Whether that's they're more commercial to deal with, I find, and I guess they're faster as well, which is key, right? If you've got a developer and they're to buy a site quickly, you can get an approval quicker, you can settle quicker, and when it comes to construction time, the progress payments are quicker as well, which is key. In terms of what we're seeing within this space, I guess since COVID, there's been an increased level of liquidity in the private credit market in particular. And I guess that liquidity is chasing exposure to commercial real estate. We're seeing that there's that increased level of liquidity. There's, I guess, also a decreased demand for that capital as well, given that it is arguably harder for a developer to activate a site, right? It's just harder for a developer to make a feasibility stack up.
Absolutely.
That's, I guess, the core of it. And I guess that's supply and demand imbalance. There's too much capital for, I guess, the amount of deals out there. That imbalance is leading to better lending terms for developers, whether that's higher LVRs or sharper interest margins, just due to that supply and demand imbalance, which is pretty interesting at the moment.
And probably the perfect kind of timing for it as well.
It is.
Pre-sales, given the market that we're going into, like
it's very tough.
It's tough to get pre-sales, particularly in certain areas. Obviously, we're primarily talking Western Sydney, but I think you can't deny the underlying demand for housing.
Yeah.
And so being able to start construction and building into a market where values, we believe, are likely to run quite heavily because there will have been nothing built.
That's right.
Is kind of, ideal timing.
Totally. Yeah. And that leads me into more my next point here around pre-sales, right? Lenders are less concerned, given, like you said, there's, I guess, such low supply and there's high migration, right? It's just
supply and demand.
It's just lenders have had to compromise, right? If they're so caught up on getting these pre-sales prior to construction, lenders are under a bit of spend pressure, right? And if they're, I guess, so caught up on these pre-sales, they'll run the risk of losing out on transactions, right?
Yes.
And even in particular, we've seen this from the banks, which I thought has been quite interesting. One transaction I'm doing with the banks that I thought I'd note is it's a strata industrial complex, 21 strata units in I think it's in Banksmeadow. Banks were keen to look at this, no pre-sale, pre-leasing basis, gearing sub 50%. But I thought that was pretty interesting, just given that we haven't seen that a lot from the banks over the past few years. And my last point here, just mindful of time, I'm going on for a while. Credit is still cautious. And I guess what I mean by that, as I said, banks are reducing loan hurdles like pre-sales, however, still undergoing, I guess, a lot of due diligence on other areas. And the main risk, and I guess this is not groundbreaking or anything, but it's construction risk, right?
Yeah, of course.
And I guess the bank's number one concern is how do I mitigate my construction risk?
Yeah.
And that's off the back of record number of construction insolvencies and a record rising build costs.
Delays.
It's tough, right?
It is tough, yeah.
And it's very tough. Lenders are scrutinising builders, to put it bluntly, whether that's engaging third-party businesses to do a review on a builder or stress testing financials. lenders are doing all these things in order to, I guess, mitigate their risk position, right?
Yeah. Still better to do your DD now, right? Than
That's right. They might be doing you a
best
favour
you
at the
can.
end of the day.
Best you can.
And look, we've noticed that's blown out deal times. Construction deals are, I guess, taking a lot longer, just given, I guess, the amount of due diligence that lenders are doing. We've found at Stamford that construction deals actually taking 50% longer, which is something our clients need to take into consideration.
Interesting.
Just given, I guess, the amount of due diligence that lenders are doing.
Yeah. No, that makes a lot of sense.
Next, we'll chat through owner-occupier funding. What we're seeing within this space, it's very similar to your typical investment transaction. So what I talked about a couple of slides back. In essence, banks just want to see serviceability, right? Whether that's from strong trading business or a third-party lease, they just want to ensure that, I guess, you as a property owner can service the interest on the debt. That's their main concern. In terms of common trends that we've noticed, again, bank appetite remains super strong. Banks are chasing exposure to strong trading businesses with good financials. One notable transaction that I'm doing at the moment, it's for an office building, funnily enough. The business operates out of that office building. Got terms from one of the banks below a 1.6% margin at a 70% LVR, which I thought was relatively sharp, given, I guess, the sentiment around office, and just thought it highlights where, I guess, margins are at the moment. And I just guess the reason why banks are, I guess, bullish on the LVR is that they typically take a GSA over that trading business that supports the rent, which is why banks can get, I guess, a little bit higher on the LVR for the owner occupiers as opposed to your standard investment transactions. Lastly, in terms of your non-banks, they can provide flexible financial requirements. Again, similar to your investment transactions, non-banks are rather flexible and can take a view here, particularly if you've got a business that, I guess, doesn't have multiple year financials under their belt, or, I guess, doesn't have strong financials, non-banks can take a view on serviceability as well. So, yeah.
Something for everyone.
Tried to cover it all.
Yeah. No, that's.
I think, we've got a few questions that have already been submitted. How about you kick things off, Pete? I'm sure everyone's probably sick of hearing my voice.
Okay, where are we? So what do we see? What are your projections for the commercial real estate market in 2025? Are there specific trends or factors we should be watching for in terms of investment opportunities, interest rates, and demands across different sectors? There's kind of a lot to unpack within that statement, within that question. I think the biggest indicator that everybody is looking for is a reduction in interest rates, particularly when kind of we're buying investment properties, because the cost of capital is directly linked to the yield that people are looking for. So I think that's probably the first thing, is to watch for interest rates starting to come off. But I also think, you don't want to be going into the market when everybody else is going into the market either, because when everybody does, it creates this kind of it creates a hyperficial inflation of prices, because there's more demand than there is supply. And so I think that I think development, in fairness, will probably kind of just continue along next year. I think that people have been burnt in the last few years in terms of buying assets below yields that they should have, with tenants perhaps that aren't as good as they could have been, or they didn't do their due diligence. And so I just think that people will remain cautious for next year. And coming back to what Harley was saying, I think, good real estate is good real estate and will continue to be. I think there's a good opportunity to get out of kind of larger industrial properties before that market perhaps softens. because I think that demand that we were seeing from the tenants and these continuing rents that kept going. I don't think that the rents will continue to climb. I think that they will sort of very much kind of just continue like this, and incentives may grow depending on what the stock is. And so I think I think it will be a year similar to what we've had, with sort of good real estate being good and people just being more cautious. So.
Yeah. And how are you seeing, I guess, incentives in the industrial space? Like, what percentage incentives are you guys seeing?
Look, it depends the asset class and the location, etc. I mean, it's really varied.
Yeah, fair enough. Yeah.
What about you? What do you want to? Next question. Oh yeah, this is a good one. I've had the same bank for over 20 years. Why would I switch? I've heard that before.
And we get asked that question a lot, right? And I think it is a good question. I think the way that I'd like to answer this is that if you're not creating competitive tension and going out to market and, I guess, running that debt tender process and covering the entire market, it's very hard to know
whether you've got the best deal.
Whether you've got the best deal or not.
And we're talking about massive amounts of money.
That's right. And I guess there's been multiple scenarios whereby, Pete, a few of your agents referred deals across, offer from their house bank. Can you guys beat it? Yes, we can, just by going through that process, right? And I guess that just going through that process, I guess we don't ask for anything out of, I guess, our clients. We're always paid by the lender, I guess, on settlement. I guess just going through that process really, I guess, ensures our clients that they are receiving the best funding in market. And I understand that, I guess, clients, they love having that relationship with a banker at their house bank, right? Yeah. And I get that. Yes. Everyone wants to feel well banked, right? And have a good relationship with someone, and have someone that they can just pick up the phone, someone they know that they can deliver. But I think what I would say to that is, and I think most of our clients will probably agree when I say this, is that they view us as that banker or relationship manager, but instead of having access to just one pot of capital at their bank, we've got access to the entire market, right? Whether that's bank, second tier bank, with private credit funders. Having that access really ensures our clients that we can get the best solution for them, because just because you're going down, I guess, the one bank every single transaction doesn't necessarily.
There's complacency from the bank.
And that's
there can be. I mean, it's
very general terms.
They
can be, right? So that's our view. I just feel like if you're, I guess, rate sensitive and you do ensure that you are receiving the best funding in market, going through that process really does ensure that, I guess, you are receiving the best outcome. And that sort of plays into, I guess, this other question here: how can you get the best price and result?
Yeah.
Very much the same, right? Like, Pete, you guys will, every time you go,
I feel like this question could be
for you
as well. Yeah.
Well, similar to you guys, right? Like, when you guys get a property,
competition creators,
you guys run a competitive campaign and you go through that process, right? And
that's absolutely what we do.
Yeah. And we do a very similar, I guess, process.
Yeah.
You're with buyers, we're just doing it with lenders, right? So I feel like that answers that question there as well.
Yeah.
When is the right time to look at refinancing? Good question. I would say at a point whereby you've signed a fresh lease, or I guess your WALE is at the longest point, right? Like,
with values it's highest.
Yeah, and like, not to say that if you've got a property and you've had a tenant that's been in there for, call it, 15 years, and they've got 3 years left, and you want to get a 2-year term and they've got multiple options, like, you're still in a fine position to refinance there. Like, you're still in a very fundable position to refinance. So I think at the point whereby, or when you've had a new lease signed, or when the value's at the highest, I think that's probably the best time to look at refinancing.
And I think the biggest thing is if in doubt, like, ask the question.
Totally.
Like, if you're not sure whether you're at the right point or not, like, Harley's available to kind of have a chat with you about, whether he thinks it is the right time, or whether it might be better to wait, or whatever it is.
Yeah. Sure.
Yeah.
I think you're right, Pete. Did you want to have a go at answering that question as well? How do you get the right price and result?
What a great question. Thanks for asking. I feel like somebody had planted this question here. No, I mean, like we pride ourselves on getting the best results. And I think, that kind of ties in with us trying to add value to our clients as well by working in with these guys, because if we can help save you money, it means that you can pay more for real estate. No, it's basically, we're trying to create this kind of ecosystem where we can add value to the people who are our people, and who, are part of our ecosystem. And so, creating value means creating competition. It's supply and demand, and the more people there are out looking at your asset. I had a discussion with somebody the other day. And he said, how do you get the best price? And I said, well, I've got a bottle of water and I've got somebody who's just come out of the desert. And now I've got another person who's just come out of the desert, and they're the people who I want to find because they will pay the most money for this thing, because they don't care how much money they pay. It's just about they need it. And so it's really about kind of finding that need or that funder to meet that requirement at that time, depending on where they are in the life cycle of their real estate. So 100%. That's kind of, but it does tie in very nicely, that relationship. I think we've got probably time for just one more question. There was a question.
Did you want to have?
Yeah, I think we might circle back on that one. There's quite a long question, which we really appreciate, but just in relation to quite a complex transaction and a number of different questions. I don't know. Do you?
I'll happily chat. Yeah, I'll chat through this quickly. So this was a question submitted. In essence, the question is, what are the various ways to help a developer fund the construction of 100 place childcare centre
with a basement?
Yeah. I think assuming the land is purchased at an 80% LVR, the first and I guess the most obvious way is funding via debt. And I think structuring a facility whereby you can fund the portion of the land within the construction facility, and the construction facility also funds the cost of the build and the soft cost and the professional fees. In essence, I've put
they need to have a lease in place.
Depends. If you go down the banking path, you'll 100% need a lease in place prior to settlement of the construction facility. Going down the non-bank or the private credit path, they're a lot more flexible. I'd like to say you can get it done without having an AFL in place. The only issue that I think that you might run into with this scenario here is the 80% LVR against the land day one. I've put a funding structure in here for a transaction that I'm doing for, I think it's a 70-place childcare centre. As you can see, the land is the top line item in the senior debt column, the 1.15 mil. That's the land debt secured against the land day one. If you're gearing that closer to 80%, you're more likely than not going to run into an LVR or an LTC issue. It's just something to be mindful of if you wanted to, I guess, purchase the land at an 80% LVR. But again, not all transactions are the same, and I guess happy to look at this if this person was on the call as well. I'll answer a couple of the other points below. At what yield will the funder assume to calculate the discounted end value? In essence, the funder, I guess, won't assume anything in first instance. We'll get an independent valuer out on site, and they'll conduct a evaluation and I guess apply a market cap rate. And I guess where are we seeing cap rates? We're probably close to this, Pete.
Yeah, 5.5, even less, depending on where it is. Sydney Metropolitan, how many kids the tenant is.
Yeah, it's based on a number of factors. It's very hard to say, right? But 5 to 5.5, depending on where it is. Does the funder require a fixed price build contract? Yes, they certainly do. Now, whether that's bank or non-bank. And number two, I missed. At what rate will the funder charge? Again, it's dependent, right? Depends where you go down, if you go down the bank path or the non-bank path. Banks will need an agreement for lease prior to settlement of the construction facility. bank rates, we have to go through that process, but I'd like to say maybe a 1.7% margin and line fee out of BBSY. And I guess in terms of your non-banks, a sub 10% margin is what we're seeing for something like this. So
I think maybe we just wrap it up there and we can have a conversation offline with this person if they'd like
Totally.
to. Yeah. Guys, well, people, thank you very much for joining us today. We really appreciate your time. We hope that what we're doing is adding value to you and your businesses, because that's what we're here for. Again, the relationship that we have with Stamford really is about trying to create value and add value to what you do. And yeah, we thank you again for your attendance. If you have any questions, please feel free to reach out to Harley. If you want to sell anything, I'll sell it. No. Thank you again, and really, appreciate your time. Have a good day.
Thanks, guys. Appreciate it. See you.
Bye.